You're listening to the Weekly Wrap-Up on Sprott Money News.
Welcome back to the Sprott Money News at SprottMoney.com Weekly Wrap-Up. It is Friday, April 23rd, 2021. I'm your host, Craig Hemke. As you know, Eric has been on a hiatus for a couple of months now, and we hope to have him back soon. In his place, we've had some great guest hosts that have been happy and willing to join us, and I've got a brand new one for you this week. The gentleman's name is Paul Wong. Paul is a market strategist for Sprott Inc. He's got more than 30 years investment industry experience, specializing in investment analysis for natural resource investments. Hey, Paul, this is great fun to get to know you. Thank you for joining me for this week's Weekly Wrap-Up.
Great. Thank you, Craig.
Hey, and most folks know, we put this on multiple platforms, YouTube and Spotify, Apple, all the rest. If you like our content, whether it's the monthly metals projections with Chris Vermeulen or the Ask the Expert segment or these weekly wrap-up segments, please be sure to share, like, and subscribe to whichever channel you're listening to today. And, of course, always keep Sprott Money in mind whenever you're looking for physical metal. You can call us at 888-861-0775. And, of course, just go to SprottMoney.com to find out more information on precious metal and storing precious metal with us, too, safely and securely. Paul, let me just kind of dive right in here. We're at a very interesting point in the precious metals. I mean, they've been in this consolidation phase, well, at least gold has in particular for the last 7 months or so, pulling back farther than maybe some of us thought. Looking like we've got some life here, bouncing off of some support down below 1,700. Just in a broad sense, how do you see the metals at this point?
For the most part, yeah, we were dramatically oversold. There was a number of factors involved, and it has a lot to do with positioning and flows. So if I can back up quite a bit, so the last 5 years, there's been this unrelenting flow into what I call the long duration trade, and that's predicated on sort of this this Goldilocks economic background of slow inflation, and so it culminated with the big blowout in the FANG names. So when COVID hit, there was a huge migration of flows into what I call the long duration trade. The poster child for that would be the FANG names. So Facebook, Amazon, Apple, Microsoft, Google. It got up to about 24% of the total S&P weight, and that was one of the greatest concentrations ever in only a handful of names. That was predicated on the notion that we were going to be in this very long, protracted, almost no growth environment, great high risk, et cetera, et cetera. So you want to go into this area of secular growth. So what's happened? So let's back a little bit more to about a year ago. So central banks around the world basically launched probably the greatest stimulus monetary and fiscal package ever seen. So that stabilizes the market. Next thing you had the big breakthrough in the vaccine breakthrough. So signs that markets could head towards a normalization. And thirdly, a democratic sweep in the U.S. ushering in these huge rounds of fiscal stimulus. So investors were forced from one end of the pendulum back to the other. So when all that happened, especially the election results and the vaccine news, everyone was basically on the wrong side of the trade, and so everyone started migrating back to the cyclical reflation story. And the problem you had was that, again, because of the nature of flows, you get this disproportionate swing, and gold, got caught into that positioning, trap, and so it got hammered down probably a lot more than it should have. Again, only because of flows. And into February, March, we had the bond yield market basically just implode. Mm-hmm. The Q1 performance was the worst in 30 years, and there were a lot of extraordinary items to that. One complicating all that was the Bank of Japan, Japanese insurance companies, other financial service companies. They were into the year end, and they were very long U.S. bonds. So they bought into the bond yield collapse into the COVID response. But they have a fiscal year end of March, so they were forced to sell, and so they pushed that down. There was the the dealers, bond dealers. They were long product, bond product, but they were also very worried about the SLR, which was the loan ratio. So they were worried that there would be changes, and basically there would be they were facing a wall of selling on the bonds. So they liquidated that into February. Portfolio managed again. Back to that reflation trade, they were super long, into bear steepener trades, and I just found out now that on a positional basis, they were anywhere from about 2 to 3 standard deviations, net short bonds. So that created that big spike in bond yields. So into end of the quarter, you have a lot of things reversing all of a sudden. You have quarter position end clearing for the Japanese. The dealers stopped selling. Positional traders are highly extended. They reposition for Q2. Markets now thinking about, okay, we pretty much discounted most of that recovery phase of the market, where all boats lift, right? Everything goes up. Doesn't matter. Everything goes up. And now we're probably migrating into that expansionary phase. The markets become more nuanced, so positioning changes quite a bit. But for gold, what I see right now is probably in the short term, probably more of a range trading. I think we got way oversold. We've now recapped it, and so right now the struggle with gold is the bond market is discounting a normal Fed response, like a normal Fed policy. Like pretty much like this. They'll do exactly the same they did the last time. They'll start the taper, and then they'll start to raise rates. The problem you have now is that huge difference, right? So, in a span of about roughly a year, there's over $5 trillion in fiscal spending with very little, taxation. So that gets added to debt. So debt to GDP is somewhere in the neighborhood of 105 to 110%. So post World War II levels. Now the question becomes, how do you normalize with debt to GDP at such an extraordinary high level? Can you do it? If you do it, because of the leverage situation, any shock that comes by is disproportionate because you're so leveraged. So you face that dilemma. So the Fed challenge is, okay, how do we taper and actually raise rates in the face of that kind of level of debt? And that's the challenge. That's very difficult. It seems to me, and also to many other market observers, is that the playbook was actually probably back to what we saw back in World War II, back to some sort of form of yield control. And that makes the most sense, because what you need to do is you need to bring down that debt to GDP level. So the last time the Fed tried to do that, the big tapering pause, 2017, 18, whatever, I think debt to GDP was somewhere around 80% when they tried. Right now we're like close to 110. So how do you get to that level? The only way to do it is basically more stimulus, i.e. add more debt to try and grow your economy. So you can see the conundrum you're in. For every dollar of debt I put into the market, can I get more than $1 worth of GDP growth? If I can't, then I dig a deeper hole. Mm-hmm. But we've been doing this for, I don't know how, since 2008. We've been digging deeper and deeper. All you have to do is look at the amount of central bank balance sheet growth that's been there. Debt's been running, I think, about 8.5 annualized since 2008, and GDP is absolutely nowhere near that level. It's multiples of GDP. So that's the problem you're in right now. So what makes the most sense is that eventually you get to the point where the Fed will probably have to come in, whether it's weighted average maturity extension, Operation Twist. Those are kind of the lower scale tweaks you can do to try and cap rates. And the big hammer would be yield curve control. But but you can probably see where they're going to go. You're going to try and see if they can get GDP growth growing. Basically, try and reduce some of that debt to GDP level first. Any sense of stall, they bring in WAM. weighted average maturity extensions, or a twist type operation, and if things go really south and sour on them, then you bring in yield curve control, and that, based on when that happens, gold will go a lot higher.
And we've got the next. I'm sorry, I didn't mean to interrupt you, Paul. I just was going to throw out that the next FOMC meeting is next week.
Yep. Yeah, you're probably too early to even talk about, twist or weighted average maturity extension. Right now there actually isn't any talk about the market, as I said, is discounting the fact that the Fed will taper and raise rates. The problem you have is that the economy is getting better and better, but you're not at the point. You haven't reached that point of escape velocity where you can all of a sudden openly talk about tapering and lifting rates, even if you're telegraphing this move years down the road. It's just too soon for that. But the market's already priced that in. So you see gold when it got below 1,700. That was a lot of confluence of factors that I mentioned earlier, and that's extremely overdone. There's a technical resistance level around right around 1,800 right now. So I'm guessing we'll probably bounce between that level and 1,765. If you look at the charts, you'll see that's roughly the neckline of a double bottom that gold put in. And we'll probably bounce along there. I have a slightly higher target around 1840, 1850. That's the target of the double bottom projection. But into the August seasonality patterns, typically I expect to see a stronger August. And again, what that likely trigger will be that the economic numbers we'll see to roughly about the end of May. It's because of the base effects. Like a year ago, things were just so bad. The numbers are going to look so good.
Right.
You see these year-over-year change numbers. Like, on the headline, it's eye-catching. Like, oh my God, it's incredible. But because the base is so low. But what you'll see is that once we get through May, those year-over-year changes will start to ameliorate, and it won't be as eye-catching. And typically into August, that's typically your seasonal period. For elevated risk, liquidity shrinks, a lot of other factors going on that typically triggers the gold rally. So I'm looking for a gold rally sometime in the August period, and we'll see how far it gets from there, and then after that. But that's the short-term picture. Longer term is still bullish. It's hard not to paint a bullish longer-term picture for gold. It's this wild trading that we've experienced in the marketplace, like pandemics to 20 trillion in 10 trillion in central bank stimulus, vaccine breakthroughs, democratic sweeps. I mean, it's amazing the amount of movement you're seeing in the marketplace. And the excess flow of liquidity. We're seeing Bitcoin looks like it's putting in a top today, but to me, Bitcoin is probably the ultimate expression of excess liquidity and market exuberance.
Back to gold, Paul. You mentioned capping long-term rates, whether overtly or covertly or through job owning, and you widen out that difference, that real interest rate, the difference between the nominal 10-year and the CPI, with the, as you mentioned, the numbers from last year, last March, last April coming off the board. The CPI now is running, even that printed number, 2.6. We are now back to the same level of negative rates on the 10-year that we were last August. Do you think that's a market inefficiency in that the price of gold was $300 higher last August?
No, I think there's a number of factors. Like real rates are important, but it's not the only factor
Sure.
that can explain the movement in gold. There's interrelation between real rates and currency as well. So you can see the U.S. dollar has been weakening quite considerably, and it's very close to touching the lows again. Mm-hmm. There's an interplay there. But if you want to get into the weeds, look at the TIPS curve.
Yeah.
The TIPS curve is basically the short end is obviously it's collapsing. It's going into it's more negative now than it was back in the summertime. People tend to look at the 10-year. That is important, but to get a little bit more color, you should probably also look at the the entirety of the curve. And the curve, it continues to collapse. It's going deeper negative. And it's really part and parcel of what the Fed needs to do. I mean, you're into how do you handle this debt? It's debasement, right? So, if you're targeting 2% inflation, that means an average of 2% or higher. Again, this is their language over, a period of time, which is, they don't specify. And you have interest rates set at 0. Yeah, you're looking at negative 2%. That's what the Fed is promising. They're promising you a negative 2% return, and that's debasement. So they're trying to, they're actively debasing the currency of their debt, the U.S. dollar. It doesn't get more clear than that.
Right.
And it has to stay there, because how else are you going to finance this debt?
Right.
Because right now debt to GDP is 110%. So what's your interest expense going to be if you let rates rise? You can't. And okay, so right now the Fed they have almost full control of the 5-year and lower part of the curve. It's tight. Most of the funding is in the 5-year or lower, but as the funding creeps up to 10 into the 5 to 10s into the intermediate part of the curve. Yeah, there's greater and greater pressure, to cap those rates to make sure that that interest expense doesn't go higher. And the stronger, it's paradoxical, but the stronger your GDP grows, the more you need to exert more downward pressure on yield. Because as GDP grows, accelerates further and further, the market wants to push yields higher and higher. But conversely, the Fed needs to push it down more and more. The only way to do that is you're going to try jawboning first, twist or wham next. And then if it gets really problematic, then you hammer this thing with yield curve control, which is what they did back in the Second World War.
Right, which is almost the final tool in the toolbox, because if that fails, then what do you have?
I wrote about it. If it fails, you got a serious problem.
Yeah.
I wrote about it, but it's kind of difficult to talk about in a very short time period. But yeah, you can see the stresses build, right?
Paul, in our remaining time, I'd be remiss if I didn't ask you about silver, because I know we have a lot of silver investors that listen to us each week. How does silver fit into the picture? Do you see it a commodity rally, and what are your forecasts for silver in the months ahead?
Sure. Silver. So silver is, I'll keep it as short as I can, but silver in this part of the cycle is very unique. It has this unusual dual feature of not only as a relative store of value, but also has a cyclical component to it as well. So, if you look at, I think I wrote in one of my reports, if you look at the silver gold ratio, it correlates incredibly well with a cyclical to defensive type equity ratio. So basically it correlates with that. So you're in a period where it's very unusual. You're in a period where yields have an upward pressure rise, and there's also a necessary store of value, because what's going on with M2, growing at 25% annualized rates, or money supply blowing out debt. So that is very unusual. If you look at the charts, what you'll see in silver is maintained as this very high level type consolidation. When it pulls back, it doesn't pull back very far, and it's building what looks like to me a very large pennant. So that is a very bullish configuration. And I would silver seasonality kicks in roughly about July. So if you look at the seasonal charts, July and August tend to be very strong. So we'll see what July looks like, but I'm suspecting it will be pretty good. The picture so far is, as I said, a bullish consolidation inside within a flag configuration. The Reddit stuff kind of added a little bit noise to it, but if you mentally X out that kind of noise, the picture is actually the chart formation is very positive. Looking at flows, the flows are again they backed off, but it's again the whole notion is you're backing off from a very, very high consolidation level. So meaning that it doesn't really pull back very far. It just tells you there's a very, very strong base level support. I think I wrote in one of the reports there's a very large also cup and handle formation on the silver to gold ratio, and through the summer expect to break out. If you see a very strong July for silver, then you tips the scales for a rally for gold. So typically gold has a seasonal rally in August. So I always use silver as sort of as a marker. Okay, if silver does really well, chances are, your probably goes up. You're going to get a good fall through in gold into August as well, because essentially they're kind of driven by the same seasonal fundamentals. But silver, once through $30, that's the next breakout level. That's the level to watch. Mm-hmm. Through that, you're probably looking at 35. Then after that, it gets really messy. It's hard to tell the charts are very unclear as to how far you can project. You can project all you want, but it's hard to tell. But typically, I don't get too far ahead of my skis. Let's get the 30 first.
Yeah, exactly.
And then let's 35, and then we'll see how it progresses on its way to 35. If you see huge, build-in option positioning, because SLV options is just enormous, right? It's probably one thing you should probably keep an eye on, because that has the capability of really lifting silver. So I tend to keep a sharp eye on SLV options activity. It's last time I checked, it's multiples greater than in the silver futures market itself. So it's basically supplanted the silver futures market in terms of trader activity. So let's keep an eye on that. But to me, I have a hard time seeing any form of bearish setup for silver. I mean, it doesn't mean it's impossible, but so far, since the big breakout about a year ago, it's been progressing nicely. It's, again, a very big, bullish, right ankle, triangle, wedge, flag formation, call it what you want, but it's there. It's just punch it up, you'll see it. It's pretty clear. It's a nice, clean chart pattern. High consolidation level. And again, if you pull back the chart back, say 10 to 12 years, you'll see that it's, I'm going by memory, so this is always dangerous, but it's roughly the equivalent around the 1650 level on gold. Every couple of quarters, I kind of refresh that chart for the monthly commentaries just to show how much potential is left in silver. There's quite a bit.
Yeah. Well, and you look at it, you think it's been a challenging start to the year. We got a long ways to go before the year is over. And silver's only down 1 or 2% year to date compared to gold being down closer to 10. So very interested to see where we go from here. And I appreciate you pointing out that seasonality too. Again, just a great discussion, Paul. Before we go, I do want to just remind everybody that Sprott Money is the sponsor of these weekly wrap-ups. If you have any questions about investing in precious metals or maybe where you can store them safely and securely, just go to sprottmoney.com, of course. You want to talk to a human being, pick up the phone. Give us a call at 888-861-0775. We're always happy to help out with any questions you might have. You can set up investments for you, precious metal storage, registered accounts. You can buy online through our safe, secure, and easy fast checkout process too. Again, sprottmoney.com for all your physical metal needs. We've been speaking with Paul Wong of Sprott Inc., and it has been great to visit with you, Paul. Very good information. Thank you very much for joining me today.
Thank you, Craig. Thank you for having me.
And from all of us at Sprott Money News and SprottMoney.com, thank you for listening. Have a great weekend.